All right, so we're going to take a look at inventory transactions. So merchandising operations, as we know, we purchase goods and we sell goods. So for instance, a company like Target, they purchase merchandise in and then they sell merchandise. So a merchandising company is kind of both a buyer, could be a buyer and a seller at the same time. And within merchandising transactions, there's a buyer and a seller. So we're going to look at some transactions from both perspectives, the buyer and the seller. So first, what happened here is on January 15th, there was the buyer purchased $1,500 of goods from a seller. Payment terms 210 net 30. So 210 net 30 means they get a 2% discount if they pay within 10 days. Otherwise, they have to pay the whole thing within 30 days. FOB shipping point, and shipping is $75. So FOB shipping point means the buyer pays for shipping and it goes to the cost of the inventory. And then from the seller's perspective, the cost of the merchandise sold is $1,100. So let's record this transaction for the 15th. So let's start on the buyer side. So what did the buyer actually purchase? They bought inventory. So we're going to debit inventory. And then how are they paying for this inventory? Well, their payment terms, they're going to pay it later. So paying it later signals accounts payable. So this is going to be for $1,500. In addition, we say FOB shipping point, $75 worth of shipping. So we're also going to capitalize the shipping costs. So our inventory, we're going to increase the value by $75. And we use cash to pay FedEx or UPS or whoever happened to be the courier of choice. Now let's look at the 15th from the seller's standpoint. So from a seller's standpoint, our buyer promises to pay us in the future. So that tells me that we have accounts receivable of $1,500. And then we actually earned revenue because we performed services or delivered goods. So now the seller always records two transactions. So our first transaction is to record revenue. Our second transaction is to record the cost of merchandise sold. So we're going to have cost of merchandise sold, which we're told the cost of merchandise sold is $1,100. So that's going to be a debit. That's going to hit our income statement. And then our credit is going to be the inventory going out. Because inventory is going out the door, we have to credit inventory for the cost of the inventory that went to the buyer. So the cost to us for our cost of our inventory, cost of our merchandise sold is $1,100, but from the buyer's standpoint, their cost of the inventory is $1,500, what they're paying for it. So next, on January 18th, the buyer returned $100 of merchandise. So they returned $100 of merchandise. So from a buyer's standpoint, does the buyer owe $1,500 anymore? No, they only owe $1,400 because they're returning $100 worth of stuff. So we're going to reduce accounts payable by the $100. And they don't have, as the buyer doesn't have that $100 of inventory anymore either. They're sending it back. So we're going to credit inventory for $100. From the seller's perspective, is the buyer going to pay them $1,500 anymore? No, because they returned $100 worth of stuff. So we're going to have to reduce accounts receivable by $100. So what's going to be the debit side to this transaction as the as the seller. So we have to reduce, we're going to record an account called sales returns and allowances. And that's going to be a debit for $100. So sales returns and allowances is a revenue account with a debit balance. So it's a contra revenue account. So this is going to reduce the revenue from the seller standpoint, because the seller didn't actually earn $1,500 in revenue now because $100 got returned. So if we net the $1,500 credit of revenue with a $100 debit, now it accurately reflects in revenue the $1,400 that the seller actually earned. All right, so finally on January 31st, the buyer's going to pay. Well, it's only 2/10 net 30, so 10 days past the 15th would be the 25th. So on the 31st, if the buyer paid, would they get a discount? No, because it's past the 10 days. But let's change this up a little bit. Let's say on the 24th, the buyer paid. So on the 24th, does the buyer get a discount? Yeah, because the 15th to the 24th is only 9 days, and they get a 2% discount if they pay within 10 days. So the buyer is going to get a 2% discount on their bill. So let's look at the buyer side of this transaction first. So our buyer, first thing we have to do is reduce accounts payable, because we don't have a debt anymore. We're paying off our debt. So the current accounts payable balance, it was originally $1,500. We reduced it by $100. So we're going to reduce accounts payable by $1,400. So how much cash is the buyer actually going to give the seller? Well, it's going to be $1,400 minus 2%. Or you can do $1,400 times 0.98. So the amount of cash actually going out the door is going to be $1,372. $1,372, but wait a minute, our journal entry doesn't work. Debits don't equal credits. So what we have to do is now we're going to credit inventory for the amount of the discount, which is $28. Because the value of the inventory they purchased was originally $1,500 minus a $100 return, $1,400. But now, because they took a discount, the inventory is valued at historical cost becomes $1,372, and that's what the inventory should be recorded at. So let's look at it from the seller's perspective. So the seller's going to have some cash coming in the door. They're going to reduce their accounts receivable because they're getting paid. And then we're going to introduce an account called sales discounts. And sales discounts is similar to sales returns and allowances, as it is a contra revenue account. So we have sales discounts. So how much cash is coming in the door? Well, it's going to be $1,400 of our accounts receivable, $1,500 net with the 100, minus 2% or times 0.98. So the amount of cash coming in the door is $1,372, which just so happens to be the amount that the buyer credited cash for. Our discount is the 2%. So our sales discount is going to be the $28. And then we're going to reduce accounts receivable by $1,400, which just so happens to be the same amount that the buyer reduced accounts payable by. So we have a perfectly harmonious financial accounting system where buyers and sellers transactions, they match, everything makes sense. So please review and reach out with any questions.